Marubeni was not born as a giant. It began in 1858 when a young merchant named Ito Chubei walked the streets of Omi, selling linen by hand. No global network, no capital markets, just trade, instinct, and an eye for opportunity. Fast forward nearly 170 years, and that same DNA still defines Marubeni. Today, it operates across more than 70 countries, spanning everything from energy and metals to agriculture, infrastructure, and even data-driven businesses. But what makes Marubeni interesting is not just its scale, it is its ability to survive shocks and come back stronger. The company has been tested repeatedly. The Asian financial crisis in 1997, the pandemic-driven collapse in 2020. Each time, profits fell, and each time, management made hard decisions, cutting weak assets, reallocating capital, and rebuilding around stronger businesses. This is where Marubeni starts to resemble the kind of company long-term investors respect: adaptive, disciplined, and pragmatic. Now, we are entering a new phase. Under its GC 2027 strategy, Marubeni is aiming for over 620 billion yen in net profit, backed by a massive 2 trillion yen capital allocation plan. But instead of spreading capital thinly, the company is doubling down on platform-style businesses, areas where scale and ecosystem advantages can compound over time. Two of these engines stand out. First, North American mobility. Marubeni is no longer just leasing vehicles. It is positioning itself inside the future of transportation. Through its partnership with Lyft and deployment of Mobileye-powered autonomous vehicles, the company is entering the robo-taxi market. This is not just a technology bet. It is layered with high-margin financial services like auto leasing and B2B financing. The combination of asset ownership and financial yield creates a powerful earnings engine. Second, agricultural inputs. Its U.S. subsidiary, Helena Chemical, has already done most of the heavy lifting. Profits have grown from 24.2 billion yen in 2018 to 42 billion yen in 2024. The 2027 target is 56 billion yen, meaning the gap is relatively small and the trajectory is already proven. With a nationwide distribution network and value-added services, this business is less about turnaround and more about steady execution. Of course, risks remain. As a Sogo Shosha, Marubeni is exposed to commodity cycles, currency fluctuations, and geopolitical shifts. But the market is increasingly willing to look past that volatility. The reason is simple. The structure of earnings is improving, and capital is being deployed with more focus. That is also why global investors, including Warren Buffett, have taken interest. Not because Marubeni is perfect, but because it demonstrates something rare: a trading company that has learned how to evolve. From a linen trader in 1858 to a platform-driven global operator today, Marubeni's story is not about avoiding cycles. It is about mastering them. But there is another layer to Marubeni's story, one that explains why its earnings quality is changing. Among Japan's 5 major trading houses, Marubeni holds the largest overseas power generation capacity. That alone is significant. But what matters more is how that portfolio is evolving. In recent years, Marubeni has taken one of the most aggressive stances on energy transition among its peers. It has systematically reduced exposure to coal-fired power and redirected capital into offshore wind, solar, and other renewable infrastructure. This is not just about ESG optics. It is about reshaping its cash flow base, from volatile, commodity-linked returns to long-duration, infrastructure-like income. In other words, Marubeni is turning energy into a platform business, and that shift is supported by something less visible, but equally important: its culture. Unlike many traditional Japanese corporations, Marubeni is known for being relatively flat in structure. Younger employees are encouraged to propose ideas. Internal silos are actively broken down. Decision-making is faster and execution tends to follow quickly. In a sector where bureaucracy often slows innovation, this cultural edge becomes a real competitive advantage, especially when entering new areas like renewable energy or mobility platforms. To understand Marubeni more clearly, it helps to compare it with the other 4 trading houses. Each of the Sogo Shosha has its own moat. Mitsubishi Corporation leans heavily on resources and large-scale industrial investments. Mitsui balances resources with strong positions in chemicals and infrastructure. Itochu has built a consumer-driven model with deep exposure to retail and textiles. Sumitomo maintains strength in metals, mining, and traditional industrial sectors. Marubeni, by contrast, has taken a different path. Its core strengths lie in agricultural supply chains and overseas power infrastructure. Instead of doubling down on high-risk resource extraction, it focuses on upstream, daily life essentials, food and energy distribution. Its U.S. agricultural network provides stable earnings, while its global power assets, increasingly green, generate predictable cash flow. This positioning may look less exciting than resource booms, but it is more consistent. And that consistency is exactly what long-term investors are starting to value. Because in the end, Marubeni is not trying to be the biggest or the boldest among the trading houses. It is trying to be something else, a company that compounds steadily, adapts quickly, and allocates capital with discipline. In fact, among the 5 major trading houses, Marubeni's total asset base is relatively smaller, but that is by design. Management has moved away from expanding the balance sheet for its own sake, and instead focuses on improving capital efficiency, especially return on equity. This is where the story connects directly to global investors. Higher ROE, disciplined capital allocation, and a growing commitment to shareholder returns through dividends and buybacks have become defining features of Marubeni's strategy. These are not abstract goals. They are measurable outcomes that signal a shift in mindset. And this is precisely the kind of transformation that attracts investors like Warren Buffett. Because at its core, Buffett is not looking for the largest company. He is looking for companies that can deploy capital intelligently, generate consistent returns, and compound value over time. Marubeni, in many ways, is becoming that kind of company. There is one more angle that quietly strengthens the entire Marubeni story: its asset structure. Among the Japanese trading houses, Marubeni arguably holds one of the most pure sets of US-linked real economy dollar assets. Roughly 60 to 65% of its assets are located overseas. But unlike Mitsubishi or Mitsui, which still rely heavily on resource projects, Marubeni's non-yen exposure is concentrated in tangible businesses: agriculture, infrastructure, and power generation. This distinction matters because not all foreign assets are equal. A mining project tied to commodity cycles behaves very differently from a business embedded in everyday economic activity. At the center of this structure is Helena Chemical, a wholly owned U.S. subsidiary and one of the largest agricultural input distribution networks in the country. This is a business deeply rooted in the American farming system, selling fertilizers, crop protection products, and agronomic services directly into the agricultural backbone of the U.S. economy. It earns in U.S. dollars, it operates locally, and its demand is tied to food production, one of the most resilient sectors in any economy. Alongside this, Marubeni's global power portfolio, especially its overseas generation assets, often operates under long-term contracts denominated in U.S. dollars or local currencies, many of which include inflation-linked mechanisms. Put these pieces together and you get something powerful: a portfolio of assets that not only diversifies away from the yen, but in many cases actively benefits from inflation and currency depreciation. In an environment where the yen weakens or global inflation rises, these assets can act as a natural hedge. This is not just diversification, it is structural resilience. And from an investor's perspective, it adds another layer to the thesis. Marubeni is not only improving its return on equity, it is also quietly building a balance sheet that is more global, more inflation-resistant, and more aligned with real economic activity. That combination is rare and increasingly valuable. To understand why Marubeni's current capital discipline matters, you have to go back to 2020. During the fiscal years spanning 2020 to 2021, all 5 major trading houses made a similar decision. They paused or sharply reduced share buybacks. This was not coincidence. It was a coordinated shift into defensive mode. The trigger was the COVID-19 shock. Commodity prices collapsed almost overnight. Oil briefly traded at negative prices. Copper, coal, and other key inputs plunged. For trading houses with global exposure, this translated into immediate pressure on earnings and cash flow. Marubeni was hit particularly hard. In the fiscal year ending March 2020, the company recorded asset impairments of approximately 390 billion yen and ultimately reported a net loss of 197.4 billion yen, its first annual loss since 2001. This was not a minor setback, it was a full reset moment. In that environment, capital allocation priorities changed completely. Instead of returning cash to shareholders through buybacks, the priority became simple: preserve liquidity. Cash was no longer optional, it was survival. At the same time, the crisis exposed a deeper issue. Before 2020, many trading houses, including Marubeni, had expanded aggressively, leading to relatively high leverage. When the downturn hit, balance sheet strength suddenly became the key differentiator. Marubeni responded with strict financial discipline. Free cash flow was redirected toward debt reduction. Management focused on lowering the net debt-to-equity ratio and strengthening the balance sheet. This phase was not about growth, it was about repair. Think of it as rebuilding the foundation before adding new floors. By the end of 2021, that foundation was largely restored. Only then did Marubeni regain the flexibility to reintroduce shareholder returns, including share buybacks, in a meaningful way. And this sequence matters, because what investors see today, higher ROE, consistent buybacks, and stronger dividends, is not simply the result of favorable markets. It is the outcome of a deliberate shift in capital allocation forged under pressure. In other words, the discipline was not theoretical. It was tested in crisis and proven. If the crisis in 2020 tested Marubeni's balance sheet, what defines the company today is the quality of its cash flow. A large portion of Marubeni's earnings no longer comes from volatile resource trading. Instead, it is anchored in non-resource businesses, what you might call real economy cash flow. This includes its U.S. agricultural platform, Helena Chemical, and its global power generation assets operating under long-term contracts. These businesses generate steady core operating cash flow. And that stability matters. Cash flow tied to food production and electricity demand behaves very differently from oil or mining revenues. It is less cyclical, more predictable, and far more defensive during downturns. In essence, Marubeni is shifting from price-driven earnings to volume and service-driven earnings. At the same time, the company has become much more aggressive in reshaping its portfolio. Through continuous divestments, Marubeni exits low-return or non-core businesses and recycles capital back into higher-quality opportunities. This is not occasional, it is systematic. Each year, these asset sales generate roughly 100 to 160 billion yen in cash. That alone significantly boosts free cash flow, giving management more flexibility without relying on external financing. But the most important piece is what Marubeni does with that cash. Today, its capital allocation follows a clear and disciplined framework, almost like a golden ratio of free cash flow. Roughly 55% is reinvested into growth areas, particularly renewable energy infrastructure, overseas low-carbon businesses, and expansion of its U.S. agricultural platform. This includes annual investment and capex on the order of 650 billion yen. Around 35 to 40% is returned to shareholders through a combination of progressive dividends and large-scale share buybacks. The remaining portion is used to maintain balance sheet strength, keeping the net debt-to-equity ratio at approximately 0.7, a level that signals strong financial safety compared to its past. This balance is not accidental. It reflects a company that has learned from its previous cycle, one that now treats capital as a scarce resource to be allocated with precision. And when you put it all together, stable cash flow, disciplined divestments, and structured capital allocation, you start to see why Marubeni's transformation is being taken seriously by long-term investors. To really understand Marubeni today, you have to confront its past, because this company was not always disciplined. In fact, it was once considered one of the most financially fragile trading houses in Japan. The story begins in the late 1990s. After the collapse of Japan's bubble economy and the Asian financial crisis, Marubeni was left exposed. Years of aggressive borrowing to fund real estate and non-core overseas investments had pushed its balance sheet to the limit. By the early 2000s, the situation became extreme. Marubeni's net debt-to-equity ratio surged to between 7 and 8 times. That means for every 1 yen of equity, the company carried 7 to 8 yen of net debt. At that level, even a small downturn could trigger a full-blown credit crisis. The market took notice. Marubeni was widely seen as the weakest among the trading houses, a company defined by leverage, not resilience. What followed was not a quick fix, but a long recovery. From 2003 to 2020, Marubeni entered a prolonged phase of balance sheet repair. Through strict capital discipline and structured plans like its V plan, the company gradually reduced leverage, first bringing net D/E down to around 2.0, then closer to 1.0. But the real turning point came in 2020. When the pandemic triggered a global commodity collapse, Marubeni made a decisive move. It recorded massive asset impairments and accepted a historic net loss of 197.4 billion yen. Painful, but necessary. Because this was not just a loss, it was a purge. The company used the crisis to clear out the remaining weak assets from its balance sheet, the final toxins, built up over decades. And then came the breakthrough. By the fiscal year ending March 2022, Marubeni achieved something it had never done before in its modern history. It reduced its net debt-to-equity ratio to approximately 0.8. Below 1.0 is more than just a number. It is a psychological and financial threshold. It marks the shift from a leveraged borrower to a financially independent operator. From that point on, everything changed. Free cash flow turned structurally positive. Debt was no longer a constraint. And for the first time, Marubeni could fund growth, dividends, and large-scale share buybacks entirely from its own cash generation without relying on external financing. This is why 2021 to 2022 is the true inflection point. Not because profits were high, but because the foundation was finally secure. In many ways, this is the moment Marubeni became what long-term investors look for. Not a cyclical trader, but a high-quality cash flow compounder. Warren Buffett once made a striking observation about Japanese trading houses. In his shareholder letters, he noted that their management teams often understand capital efficiency better than many U.S. companies. Marubeni, especially from 2021 to 2026, is a textbook example of what he meant. After rebuilding its balance sheet, the company did not fall back into the old habit of expansion for the sake of size. It resisted the temptation to deploy excess cash into unrelated low-return acquisitions. Instead, Marubeni kept its asset base lean and focused. This is a subtle but critical shift. Growth is no longer measured by how big the balance sheet becomes, but by how effectively each unit of capital generates returns. At the same time, management executed a highly disciplined asset rotation strategy. Every year, Marubeni systematically exited low-margin, carbon-intensive, or non-core businesses, recovering over 100 billion yen annually in cash. That capital was not left idle. It was reinvested into areas with stronger long-term economics, particularly its U.S. agricultural platform through Helena and its expanding global renewable energy portfolio. This is not just portfolio management, it is continuous optimization. And then comes the final piece, the shareholder return loop. In 2022, once financial stability was firmly in place, Marubeni restarted share buybacks, beginning with around 60 billion yen. But more importantly, these buybacks were paired with share cancellation, effectively reducing the share count. This creates a closed loop. Capital is generated from stable operations to recycled through disciplined divestments to reinvested into high-return businesses and excess cash is returned to shareholders through dividends and buybacks that enhance per-share value. Over time, this loop compounds. And this is exactly the kind of system Buffett looks for. Not just profitable companies, but companies that know what to do with their profits. In that sense, Marubeni is no longer just participating in global trade. It is operating as a capital allocation machine.